From the morning reading, spiders, IWM, XLY, and bull flag price patterns, XLB, XLE, XLF, and day one pullback. Steel stocks on the rise. Breadth strengthened compared to the prior session as advancers led 1649 to 1345 on the New York Stock Exchange and led 1413 to 1343 on the Nasdaq. On the S&P 500 snapshot, we had a flat Friday, down 0.97% for the week. The S&P 500 gave a modest morning rally to its 0.31% intraday high following a better than expected November jobs report. It then sold off to a shallow red at the end of the lunch hour. A bit of buying in the final hour lifted the index to essentially flat finish and a weekly loss of 0.97%. The sell-offs in Treasury took a pause. The yield on the 10-year note closed at 2.40%, 5 basis points off its interim closing high set on Thursday. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I'll provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:27 a.m. Mountain Time, and I'm recording this in preparation for the market day of December the 5th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Okay, let's go ahead and bounce over to the morning report. At the time of this cut, the U.S. futures on all four of the broad-based indices were up. S&P futures are up about 1/3%. Russell futures were up about 0.8%. Nasdaq futures are up about 0.4%. As was the Dow futures. Crude oil up about 0.75%, euro up about 0.25%, bonds down about 1/3%, and gold down about 2/3%. China down about 1.2%, Hong Kong down about 0.25%, Japan down about 0.8%, Germany up nicely about 1.5%, and United Kingdom up about 0.2%. In terms of macroeconomic reports for today in the United States, of note, we have FOMC member Dudley speaking, ISM non-manufacturing PMI, and FOMC member Bullard speaking. And looking forward to tomorrow, we have non-farm productivity, trade balance, and that looks to be about it. In terms of current volatility conditions, short-term VIX at 13.64, skew slightly elevated just above the 125 threshold in which to put it into caution status. IV percentiles continue to be relatively low, though up off of their near lows. S&P at a 26, the Russell at a 23, the Nasdaq at 25, and the Dow at a 22. On Friday, there were no standard deviation size price moves on any of the four broad-based indices on a close-to-close basis. Let's go ahead and bounce over to the charts. Okay, on the S&P futures, you can see Sunday night into Monday morning's action, also including the results from Italy's referendum and its impact. Right now, after having undercut the area of support, it is now well up above that, and we're basically back to about Thursday's opening price. So pretty interesting turnaround there. So a pretty strong opening would be apparent with an hour to go before the cash participants come into the market. The S&P futures up strongly from their start. In terms of the bigger picture, this right now looks to be a classic bull flag pattern, a breakout, a retest of the former resistance area, now turns support, and that support seems to be holding. And then if this price were to hold up into the open, we would have a bull flag activation, and with the expectation that we would take this up to the former highs and then beyond. In terms of the Dow, Dow also breaking out above its recent short-term horizontal resistance pattern and has made a new 52-week high and frankly all-time high during the overnight session. And then Nasdaq's also had a reversal. Obviously, this one's coming from a much weaker pattern and is right now approaching the bottom of the cloud. So it's been range bound while the Dow and the S&P have been so strong. And then the Russell, right now we've had kind of what appears to be a false breakout of the top of the channel and now a retracement back into the channel. Some bullish action also in its overnight activity, but until we establish something above this channel, we have to presume that this is back to the channel and perhaps could ride the top edge of this channel, but that we're back into the channel is the primary pattern. Still quite bullish on the Russell here. In other markets, crude oil is breaking out, and we've had this area of resistance right now in the overnight action. We are above that and closing in on the intraday all-time, intraday 52-week high that crude oil had previously put in back in October, middle of October. So things have gotten very, very bullish on crude oil. In terms of gold down and seems to be setting up for potential next leg down. Gold's in a strong bearish trend. In terms of bonds also down in the overnight session, would also seem to be in a strong primary bearish trend and would be looking to set another leg down. And then let's take a look at, let's take a quick look at dollar. Dollar, big move down in the overnight. And then volatility also edged off in the overnight. So the reaction to the Italy referendum seems to be one in which, while especially the Italian financial markets, I understand, were off, all these other markets seem to be responding as if it was, in quotes, good news. So whether it's Italy that's weighing or not weighing on these markets, or it's other factors, we look to have a pretty strong opening for equities in terms of our Monday morning opening. And in terms of the short-term setups, following through to intermediate-term setups, the bull market still seems to be in place. Let's go ahead and take a look at the daily report. We've had some changes here. Intermediate-term phase opinion recently has turned to market phase 4. These are price patterns near resistance and extension. This was bull flag, and obviously we'd had some deterioration at the end of last week. This could reset back into bull flags here quite quickly. It was just kind of a short undercut underneath the moving average here that gave us this market phase 4, and that may very well be quickly nullified as a false breakout to the bottom side. In terms of the 3 market timing signals, the first one from IBD, uptrend under pressure, so that one's in cautionary stage. GMI index, 5 out of 6, buy signal that's been in place since 11:10, so that one's still bullish. Stock charts decision point scoreboard, our most recent change in signal has been on the Nasdaq, which saw a bearish signal come in on the short term. So we'll continue to have this really kind of messy overall situation. If you put all 3 of these together right now, we seem to be a bit challenged, but overall I think we'd still put this to the bulls. And but the primary thing to take away from this is not yet a healthy bull market. We need to see that series of higher highs and higher lows. We've talked about this for months now, and while we've had appearances of that starting to form, we're not yet quite there. And you can see that most evidently on the decision point scoreboard, where you have these mixed signals on the intermediate term trend and very much mixed signals on the long-term trend, still not giving us that kind of all clear signal to be the most aggressive that we can get. Position sizing opinions, one is at 50% based on the portfolio investor position sizing opinion, and the other one based on volatility is at 75 to 100%. Intermediate term market posture, you can see we've had some deterioration here. Nasdaq dropping into weak bear, though the most important one, the S&P, as well as the Dow and the Russell, still in severely strong bull, and they're all supported by a strong bullish sentiment line. So given that, these retracements are expected to be relatively brief, weak retracements to the bear side, then resumption of the stronger bullish leg. That is the expectation from these indicators. Hedge warning status remains level 0 plus, normal with some elevated conditions. Overall strategy opinions, nothing's changed here from last week. All three of these opinions are giving us, in quotes, permission to initiate new positions for novice traders, and yet at the same time, some relatively defensive structures in the covered call still, a 1-to-1 ratio still in place for the in-the-money, out-of-the-money strikes. Same thing with the low beta versus high beta. So some defensiveness still yet in play. And until we get a stronger trend and a stronger, what should I say, market timing signal systems and so forth, it'll be probably more the same there. In terms of the specific areas of warning, most things that we saw go red last week have resolved. We still have this high distribution day count in the Nasdaq, 9 currently. Skews somewhat elevated. VIX has been through last week starting to tick up a little bit, but this is a very minor kind of tick up. This also, the skew is relatively minor. So while we have 3 areas in the red here, I would put 2 of these in the minor category. The most troubling one here is the distribution day count on the Nasdaq being 9. In terms of trend-based, this area, this going to market phase 4, not quite as strong a bull pattern as you have in the bull flag phase 3 pattern, but still nothing really concerning in this area. And the key intermarket risk aversion indicators, we did have 2 go just barely to risk off, and the other 3 have been showing some signs of rolling over. I suspect that all these could roll back to risk on in a day or two if this current price action follows through from Sunday night into Monday morning. From a sentiment standpoint, we're at 71, and it's been relatively stable in recent sessions, so nothing particularly concerning there. In terms of sector specific, Friday was basically a risk-off day, and many of those sectors that have been pummeled since the post-election period did pretty well on Friday. Real estate, utilities, consumer staples, healthcare, all in the positive with pretty decent breadth across the sector components. Whereas some of the more recent winners gave up some stuff on Friday, financials, and then consumer discretionary and industrials in particular. Industrials pretty much scratched, though breadth was perhaps a bit more to the negative side. And we continue to see this sector rotation reflected in our market postures across the 3 time frames, with on the downside consumer staples, healthcare, utilities, and technology, and then perhaps mixed signals on consumer discretionary and retail. And then on the positive side, we've had a lot of strength coming from financials, industrials, materials, and transportation. So let's take a quick look at the relative rotation graph. And you see, again, regional banks, transportation, and an improving retail are probably the 3 strongest ETFs that are showing up on the relative rotation graph at this point. And then falling back are the Internet Index Fund and biotech and semiconductor, having fallen from the upper right quadrant now into the weakening quadrant. So kind of be aware of some of that movement there. Okay, I think that's probably enough for today. We actually a bit short for Monday, but I'm doing that on purpose. I was a little late getting started with the recording, so we're going to go ahead and move through this and get this out. And disclaimers, as always, hit the pause button if you need more time to review the disclaimers. Also note the hyperlink down here at the bottom for the full set of disclosures. We'll be back here tomorrow morning for the next session with the Falcon Global Market Preview. In the meantime, manage that risk profile and you'll find everything else should fall into place. And each and every day, seek to go out there and learn something about your chosen trade, investing, and trading.